Thank you for joining us today for our educational webinar on real estate investing. Today's topic is a very basic level investing webinar on using retirement dollars to invest into real estate. Opening new doors is my topic. If you're a real estate investor, you know how much doors actually matter and count to you. So I'm going to show you a little bit of how you can actually use your retirement dollars to continue your real estate investing journey. My name is Corey Daharsh. I have been with Advanta IRA for about 7 years now. I started in 2016. I also obtained my CISP, or Certified IRA Services Professional designation, in 2018. And in my time with the company, I have helped thousands of investors execute transactions from small lending deals all the way up to multi-million-dollar real estate transactions. So I've basically seen a lot of different ways that people use their retirement dollars to invest into real estate. And if you have specific interests or would like to speak about a scenario or a strategy, please feel free to reach me. My phone number is here, my email address, and my 2 social media pages relative to my working life are listed here as well. For anyone interested, I'm happy to share a copy of today's slide deck. Feel free to email me and I can send you a PDF copy. And the recording will also be posted on our YouTube page in about 24 hours from this live recording that's being handled right now. And if you are with us live right now, I will have the audience muted for the duration of today's webinar, but I do want your participation and I do want to answer any questions you may have. So please check GoToWebinar's task panel that you have on your screen. You can use the question box to go ahead and type in any questions as I'm presenting. If they relate to my slides and the presentation as I'm going, I'll be happy to address them then. And if they don't necessarily relate, at the time I'm presenting, just to keep me on track, I will go ahead and cover anything miscellaneous at the end before I conclude officially. Having said all that, I want to give you a little bit of information about Advanta IRA. We are a self-directed IRA administrator and have been in the business for 20 years now. We have about 10,000 active clients and just over 2.3 billion in assets under management. I actually think that's closer to 2.5 right now. So I'll need to update this slide. Our clients' funds that are not actively invested, so if you don't direct the money into a deal, it is sitting with Advanta in a trust bank account insured up to FDIC limits, so you don't have to worry about that money that is sitting idle. And every client that we have is partnered with a dedicated client account manager, a one-to-one person that you'll deal with so that you don't have to reach out to a call center and explain what your interests are and what your new transaction is to a brand new person every time. You'll have one point of contact that you get familiar with and likewise gets familiar with you so that helping you and assisting in your investment journey is as simple as possible. A brief disclaimer about today's webinar and just Advanta IRA in general. We are, again, a self-directed IRA administrator, and as a self-directed IRA company, we are not able to convey any tax, legal, or financial advice. So everything I talk about today and the examples I'll provide in my case studies later are strictly for educational purposes. You'll notice that my case studies have rounded numbers. It's not exact. It's there to paint the picture for you and allow you, again, as a self-directed investor, to do your due diligence and underwriting and all of your own follow-up that you may want to do before conducting any investment transactions. We always implore you to work with your own team of CPAs, tax preparers, financial advisors, accountants. And if you need referrals for any of those specific services, you can let us know. We do have some partners we'd be happy to refer you to, but it's completely at your discretion to reach out, decide to work with them or not, and proceed with those various services. So what is a self-directed IRA? If you're not familiar, it's basically a retirement account, just like one you probably already have, with a custodian like Advanta or administrator that is willing to let you make any investments that you see fit, as opposed to serving as a fiduciary or a financial advisor that limits you to specific assets that they've already vested out and done due diligence on. Again, A financial advisor is only going to let you make investments into assets that they have done research and underwriting on. A self-directed custodian that is not a fiduciary simply follows the IRS's rules and regulations, which is what we're experts in, and lets you make your own investment decisions and drive your retirement dollars however you see fit. If you have not heard about self-directed investing, that's perfectly fine and very common. Not a lot of people know this exists. That's why we are out here providing as much education and networking as best we can. But it is also something that is a very useful tool for people that are already investing their money and looking for tax advantages. Only about 4% of US-based retirement accounts are self-directed right now. And the total amount in those types of retirement accounts, we're talking your IRAs, your employer-sponsored plans, is sitting right around the threshold of $40 trillion. So it's a lot of money that people have set aside in tax sheltered accounts that are just not taking advantage of driving their own investment decisions, as opposed to going to someone that they're being charged, whether it's a flat rate, points on investments, points on interest or earnings, for the services rendered. As I just alluded to, there are a number of different types of plans that can be self-directed. Most of you are probably familiar with a standard traditional or Roth IRA, which can be self-directed, but we also offer SEP and simple IRAs for small business owners, solo 401k plans for sole proprietors or those that are just generating self-employment income, maybe with themselves and their spouse, but have no wage earners within that self-employment income resource. And we also have health savings and education savings accounts that can be self-directed. So if you either have a young one in your life that is going to have educational expenses, you can have a retirement account that builds tax-free or tax-deferred income to pay those expenses. And the health savings account is for anyone that qualifies for a high deductible health policy. You can have a health savings account and self-direct the funds in that account, which is really, if you look at one of our other webinars specifically on that topic, it's something of the holy grail where it's a triple tax advantaged account. I'll just leave that little bit of nugget, and if you're more interested in an HSA account, please look at our other content and information or reach out to me directly. I'd be happy to provide you additional information and outline some of that further. So why do people choose to self-direct? Well, they first have to hear about it, which is kind of the context of this webinar today. Then they have to realize, okay, this is a new source of capital or a new funding source for some investment strategies that I already have interest in or may already be partaking in. Some people are getting fatigued with the stock market, whether you have an account that's been on the downturn, given the local and regional and nationwide economy lately, or just the tax benefit in general. Making some of these investments are letting your money grow completely tax deferred, or sometimes tax-free if you already are investing with a Roth account, whether it's a Roth component 401k, which we do offer, or a Roth IRA account. Again, or that triple tax advantaged HSA account can also benefit to that effect. But there's great tax benefits to using your retirement dollars. And today, specifically in real estate investing, I'm going to cover a few examples and case studies a little bit later on. But first, let me just explain to you how simple it is to get these funds into a self-direct account once you decided to route you're interested in going. So there are really three major ways that people fund retirement accounts that are self-directed. The two that I'm going to speak about here are transfers and rollovers, and I'm going to explain those specifically. And just real briefly, the third way to fund your account is with a new money contribution. So with IRA accounts, you're eligible, as long as you have earned income, to contribute up to a designated amount each year. For 2023, which is the year of this recording, the calendar 2023 tax filing year has a contribution limit of $6,500 if you're under age 50, and if you're over age 50, $7,500. There are some circumstances related to your annual income if you're doing a Roth IRA or a post-tax account where you may be phased out of the contribution limit. Again, we have great education either on our website or on other videos that we've put out on where you may stand with that, and we can answer and help you with that specifically when you're ready to cross that bridge and start looking into setting up your account. Aside from new contributions, the other main way these accounts are funded are transfers and rollovers. Put very simply, a transfer is when you're moving money from an existing IRA account into a self-directed IRA account. It's typically facilitated within about a week, and you just fill out a custodian to custodian transfer form for the receiving party or the company you want to receive the money, and they follow the protocol set by the sending party to submit that transfer request, follow up accordingly, and coordinate receipt of funds so you can start self-directed investing. This is a non-taxable, non-reportable event and really just takes place with a little bit of paperwork between two different retirement custodian or administrators' back offices. The other way that I'm going to outline to move funds into these types of accounts is known as a rollover, whether it's a direct rollover, which is more common, or an indirect rollover, which is also sometimes known as a 60-day rollover. The difference there, and the whole precedent for a rollover, is that you have funds in one type of retirement account, usually a 401k plan or employer-sponsored plan for a job you've left. So if you worked in the school system and had a 403b account, or you worked for the government and had a thrift savings plan, or a 457, any of these types of plans, if you've left that job, that is really easy money to move over to a self-direct plan. And it's really important, I can't stress this enough, once you leave a job, that money is free and fair game for you to do whatever you'd like with it. And sometimes you're actually not even benefiting from leaving it with that employer because they sometimes may take you out of the profit sharing once you terminate employment, but never reach out to you or take a while to reach out to you and say, hey, you've got these retirement dollars here with us. We know you've left. What would you like to do with them? So doing a rollover just involves initiating a distribution out of those employer-sponsored plans, and the direct or indirect portion comes into play here. You can either make sure the funds are payable directly to your new retirement plan and have them sent directly there, constituting a direct rollover where funds never touch your hands. There is some tax reporting, but as long as the amount you take out is the same amount you put into the new plan, it's a complete wash on the tax documents reported by the sending custodian or administrator and the receiving custodian or administrator. The other way to do this, the 60-day option, the indirect rollover that I referenced, is when you actually take personal possession of the money, and the IRS allows you 60 days from constructive receipt, which is basically the day that the wire hits your bank account or the check is in your mailbox. You have 60 days from constructive receipt to deposit that money into another qualified plan and avoid a tax consequence for the distribution out of your previous plan. So I hope that thoroughly outlines, again, how simple it is to move funds either from existing plans, making a new contribution, or from previous employer existing plans that you may want to use to fund a self-directed investment strategy. The timeline in general really can be about a week to 2 weeks or so. It's usually not more than 2.5 weeks, but that's something that we'll help you with on the onboarding side, learning where your funds are coming from, what the protocols are for those companies, and what the timeline you should expect would be so that everyone has a reasonable expectation and a timeline for when you'd like to get your investment funded versus when you're starting the account and getting everything set up. So the rules for self-directed investing are actually very simple and relaxed in a general context. There's only a few different ways that the IRS tries to restrict what and how you invest your retirement dollars. They start with prohibited investments, which are basically things you're not allowed to invest into in basically any context. Life insurance policies and an IRA, you can't hold those. Collectibles, which are like antiques, fine wine, artwork, anything the IRS would see as a subjectively valued asset, they do not want you to hold in your retirement account. I always use the example of a neighbor up the street from me has an old rusty Chevrolet Corvette, and he may think it's of high value, and I don't. It's just been sitting there, not moving, collecting dust, collecting rust. So I would not value that asset at the same thing that that neighbor would value it as, obviously, because he's left it in his yard for so long. So that's something that he is surely not owning in the name of his retirement account. The other item listed here, precious metals. There are some precious metals or currencies that you can invest into. Again, that's a separate topic for a separate day. But if you're interested in that, feel free to reach out to me, check our YouTube page or our website, and you'll find some great information about precious metal investing. Aside from prohibited investments, the IRS labels certain transactions as prohibited as they relate to who you're doing those transactions with. So there's what's known as disqualified persons from your retirement account that you should not be dealing with on the opposite side of a transaction. So that means I cannot buy a property from a disqualified person in context of real estate investing. I cannot let a disqualified person be a tenant in a property that my retirement account owns. Now, you can go into a deal at the beginning with a disqualified person as long as it's set at the outset of the investment that you and the disqualified person are partnering together. But aside from that, you should refrain from dealing in any transaction sake with a disqualified person or someone you think would be a disqualified person. And if you have questions, speak with your account manager or an Advanta representative, and we can answer and help you with that as it relates. UBIT and UDFI taxes are little known taxes that may apply in some investment scenarios. I'm not going to go into that today. If you're interested, you can check our website, or we actually did just post a UBIT UDFI webinar very recently, so you'll find that in our very recent queue on our YouTube page. Now, those disqualified persons rules I just referenced, it's really simple for me to outline those even. Disqualified persons for an IRA account as set forth by the IRS would be yourself, your spouse, and anyone on your lineal tree up or down. So your parents, your grandparents, great-grandparents, as long as are still alive, are considered disqualified persons, and your children, your grandchildren, as far old of a grandparent you may be, you're not able to interact with those individuals' retirement accounts. Again, from a side of buying or selling between them and your retirement account. Or businesses that these individuals own, I would like to mention, are also considered part of the disqualified persons rules. So just a few quick examples here that I believe I referenced a few moments ago. Your father's IRA cannot lend money to you or your son. Your IRA cannot make a down payment on a property that you personally guarantee a mortgage for. If you're looking to make that type of real estate investing, that's another webinar we actually did a few weeks back on how to make an investment with real estate when your retirement dollars can't cover the full amount of the real estate transaction, or you are just trying to use it for partnering purposes. It's very important with self-direction to invest with people you know. If you're an investor, I'm sure you're very familiar with the triad of know, like, trust, but it really comes to play when you don't have a financial advisor or anyone overseeing your investment strategies and intentions. It's completely up to you. Again, as I said earlier in the disclaimer, do your research, do your due diligence, consult with the appropriate professionals, and network within your investor community, whether that's your local RIA group, whether that's a meetup group you found, or another group locally that meets with like-minded individuals trying to find deals and work together. Make sure you're comfortable and get references as you're making prospects and deciding when and where to invest. So with real estate and retirement investing, what choices do you have? There's a number of different asset classes that all fall within real estate investments that you may be interested in or may have not even known about until you either see it here or do a little bit more research now that you are bridging the gap and learning more about what options you have here. So you can own single family homes, multifamily homes, you can joint venture on a project. If you're someone just getting started and getting your feet wet, whether it's with your balance in a retirement account or just your comfortability, Tax deed and lien investing is a great way to get started with lesser dollar amounts typically. And then syndication investments or limited partnershiping, wholesaling, private lending, and even option contracts are all different things on the spectrum of real estate investing that you can do with your retirement dollars. Again, the specific assets here, single family homes can be held for multiple different strategies even. For a long-term rental project, a short-term rental project where you're doing Airbnb or VRBO, or even rehab projects, so fix and flippers. I'll get into that a little bit more on the nuances of fix and flipping, but it's important to just know what all opportunities you have available to you. And as I covered with the rules and the disqualified persons, it's very, very wide and diverse. So let's talk about the strategy and scenario of making a real estate investment. For any of the aforementioned investment transactions, you're basically going to be making sure that you're purchasing the property in the name of the retirement account. All of the funds need to flow through the retirement account. So the closing costs come straight out of your IRA or 401k. All of the proceeds generated by that property flow right back into it. And in the meantime, if you're flipping or owning for a longer term and you have any expenses of that property, let's say putting in new flooring, a new roof, even something nominal like light bulbs and household materials, that all needs to flow in and out of the retirement account specifically, not your personal pocket. If you're someone that wants to be a little bit more hands-on, I do have a case study I'll cover later that gives you that flexibility and freedom while real estate investing. But in general, I want to hit home the basics here so that you completely understand what you're getting into with real estate investing. I do see a question just came in. I want privacy with this investment. Can I use an LLC? That is actually exactly what I was just referring to. And I will cover using an LLC in my case studies later on. So yes, you can. I will cover exactly how, why, and what in a few moments. That is a quick reminder as well. If I'm going here and you have questions, you want me to hone in on any specific thing I'm speaking about, please do not hesitate to reach out on the questions box in your GoToWebinar panel, and I'll be happy to address those. So as I just mentioned, expenses all need to be paid out of the retirement account. The only caveat there is if you're splitting ownership, so maybe this property is a 50-50 deal with your retirement account and someone else's retirement account, or someone else as an individual, then your retirement account is only subject and required to pay its portion relative to the ownership on the deed of title. You could also separately employ a property manager. Now, some people don't want to do this because it does cut into the profits generated. But if you're someone that wants to be more hands-off, you can certainly prospect property managers and sign an agreement with one so that they're basically handling the general cash flow and remitting any residual proceeds back to your retirement account in whatever increment you agree to with the property manager. It's completely up to you to do your due diligence, agree to terms with the property manager. But if you do so, that's something that we would have on file and coordinate directly with property management teams to assist in your retirement investment goal. So, managing the property and who can and cannot do work on the property. This falls into the disqualified persons rules that I referenced earlier when it relates to utilizing repairs or maintenance on a property. You and/or any disqualified persons are not allowed to do any sweat equity on a property owned even 1% by your retirement account. This even boils down to something as simple as changing a light bulb. Realistically, from the IRS's rules, you should be having, at the very least, a handyman come over to do those types of services. The rules do not stipulate that you have to get licensed and insured professionals in each specific category like plumbing or electrical. That's completely up to you and at your discretion, as is owning insurance policy over the retirement account owned property. But again, you can't do sweat equity yourself, nor can any disqualified persons to you. Anything else does have to be done by at least a handyman or someone that you trust that's not disqualified. If you're going to rent the property, it's completely up to you, very similar to the property management that I just outlined, to come up to terms, find the tenants that you want to deal with. You are the retirement account holder. This is a self-directed account, so you as the self are really driving here and making these types of decisions. This is not the retirement account administrator's responsibility or duty to place tenants in your property. If you're someone that doesn't want as much of that responsibility here, then maybe a syndication investment may be more along your lines, or even working with a local group like housing department or housing authority for Section 8 or other HUD-based housings, where they can help you place tenants. They cover a portion of the rent, so you know your income is going to be somewhat secured from that standpoint. And then the tenant in the property is covering the rest of the portion of the rental income that gets into your retirement account. Also, with those types of structures, sometimes they do extra vetting. They do visits to the house to make sure the tenants are living up to their side of expectations. So there are pros and cons with Section 8 or HUD housing. It's definitely something to consider if you're getting into this thing, but again, at your own discretion and at your own due diligence. So that really concludes the educational component today. What I'm going to do now is pivot a little bit and put everything I've just explained to you to action with 4 separate case studies covering different avenues and options for real estate investing with retirement dollars. My first case study here is purchasing rental real estate with your retirement account. In this scenario, I've got an individual named John who has a 401k from a previous employer, and he decides he wants to own a rental property that went up for sale down the street from his house. So John opens and funds an account with Advanta IRA. He finds that property down the street in his neighborhood that's valued at $200,000. Again, as I referenced earlier today, please keep in mind my numbers are going to be rounded for these scenarios. So don't look too deep into the specific numbers. Consider more the context and the principles I'm outlining here. So he finds the property. It's valued within an amount that he has and has money in case he needs it for unexpected expenses or other things that need to come out of that retirement account before it starts generating income. So he makes an offer to purchase the property and submits the purchase paperwork to his Advanta IRA representative, his client account manager, to start coordinating the closing transaction. So Advanta IRA's role, once we know that the property is under contract, we will coordinate with the closing team directly to make sure everything's in the proper name of the retirement account, that John's tax ID number isn't shown on any of these documents. Instead, it's the tax ID for the retirement account. And once John approves all the closing documents, the account manager actually executes the transaction, sends the funds to closing, and Advanta IRA will hold all of the recorded original paperwork in our safety deposit and security storage. And then the income and expenses are all facilitated and coordinated through Advanta, usually through our online portal and emails. That's the quickest and easiest way to handle it. You as a client with an online portal for Advanta have 24-hour access to submit requests when expenses need to be paid, or you can even set them up easily on a recurring basis, so you don't have to worry about your utility bills every month and different miscellaneous things that are static and not going to change. So in my investment scenario here with a $200,000 property, the property gets rented out for $1,500 a month for 2 years. That generates $36,000 in rental income. After about 2 years, John decides he wants to sell that property, and he sells for $275,000, netting a $75,000 profit at the sale. Again, there's no taxes paid on this, either tax deferred or tax-free retirement account investment. So it is not subject to capital gains, which would be the case if John made this investment out of his personal savings and direct pocket. That's the benefit of using the retirement account here. And now, all in all, with the 75 and the 36,000, that generated $111,000 in profits realized. And John, totaling his initial $200,000, now has about $311,000 to turn around and invest into either his next deal or deals plural, because if you look at making a first property of 200, if he just goes to a little bit lower class of a property, he may be able to buy two separate properties at roughly 150, 160 or so, depending on how much other money he had set aside in other retirement investment strategies. Again, well, maybe not again, I don't think I said it earlier, but this can be used as a diversification tool. So this may not be John's only nest egg. He may still have funds in a managed account that are invested in stocks, bonds, and mutual funds. So just knowing what your overall nest egg is will help you in determining when and how to move into the next asset class or bump up or down with your investment strategies as you move along. So my next case study here is very similar, but in this case, we're going to partner. So we're going to join in a team with either another retirement account or another individual. So I've got Paul and Linda. Paul and Linda would like to partner their retirement accounts to invest into a property. They each have $100,000 in their IRAs, and they find a property that's valued at $150,000 that's going to need a little bit of repairs before it's ready to be rented. They estimate that they'll make about $1,500 a month in rent that will go into their retirement accounts once the property is upgraded. So Paul and Linda set up and fund their retirement accounts. They make that same offer to purchase the property, again, in the name of those two retirement accounts. More specifically, the ownership is going to be split exactly by the dollar amount each retirement account brings to the table. So for context, this is going to be a 50-50 scenario, but it could be 25-75. Any percentage could be the breakdown. I've seen clients use 95% personal money, 5% ownership in the name of their retirement account because they were just getting started and just kind of dipping their feet into the use of retirement dollars in real estate investing. It's completely up to you. The side of Advanta is exactly the same here as it was in the last scenario, except that there are two accounts involved this time, not just one. So we're flowing cash in and out of both Paul and Linda's retirement account whenever any expense comes up, again, based on the ownership percentage on file. So at a 50-50%, let's say a $10,000 roof needs to be done. Well, then Paul and Linda need to have $5,000 of residual cash, which we already confirmed they do have, so that they can pay those expenses before the property is ready to rent and generate income to flow back into those accounts. My third case study is a little bit more hands-off. This is investing into a syndication deal as a limited partner with your retirement funds. So I've got this scenario where Larry has $100,000 or over 100 in an IRA with a managed custodian. He meets Malcolm, who has a syndication deal. So he's a capital raiser or a fund manager, general partner, if you will. And Malcolm and Larry discuss the deal in question. Malcolm provides the subscription documents, the prospectus, often sometimes known as the private placement memorandum, all of the paperwork to outline what the deal is, what the expectations are. Larry looks it over, does his due diligence, consults with whomever he decides, and decides he does want to make this investment at the minimum threshold, which is $50,000. So Larry sets up a self-direct account, completes a transfer request form, which I referenced earlier, to move $50,000 plus potential any amounts that he may want to move for other investments or residual to be left in the account for expenses that come up or anything like that. And then Advanta submits that transfer request and lets him know when the funds hit our accounts. Typically, he gets an automatic email, but can also follow up directly with his account manager on his online portal. The next step is coordinating the investment transaction. So the subscription documents are going to be executed in the name of the retirement account, which, as I've shown in a few of these previous examples, is going to list Advanta IRA for the benefit of Larry's name and then reference to his account number. It does not have to have both the name and the account number if you're someone that is looking for more anonymity, but it does have to have one or the other to be a full, accurate vesting for your retirement account. And again, as I've said multiple times, the tax ID number tied through this investment is going to be the trust tax ID for Advanta as the account administrator custodian, not the individual social security number, so that he does not have any issue with any tax repercussions later on down the line in the future. So in this scenario, going full cycle on a syndication deal after about 5 years, Malcolm's partnership pays an 8% preferred distribution to all subscribers. That's about $4,000 per year. In the 5th year, the project is refinanced, which is a common scenario with these types of transactions. And at that point, a lump sum payout of $65,000 is sent to Larry's retirement administrator. When we received that, he basically has been full cycle with that deal, generated about $35,000 of income just for placing his $50,000 for about 5 years into that deal, and can turn around and invest all of that money into the next deal with Malcolm or any other investments that he may want to, now that the money is back in that retirement account for self-directed purposes. And my final case study for today, which is something that one of our guests asked a question about. This is using checkbook control or a single member LLC to route your investments through. So a brief explanation and outline of checkbook control. This is a strategy where an investor sets up an LLC that is fully funded and owned by the retirement account and managed by the retirement account holder, so that the retirement account makes an investment into the LLC, and then the LLC actually makes the real estate investment transactions at the timeline, discretion, and exact execution of that account holder. So on our records, we hold an investment into an LLC. When we execute that transaction, the money sent to a bank account you establish in the name of that LLC. And from there, it is completely up to you to make your investments in the name of that LLC, whether you're buying a physical piece of property, you're partnering with another investor in the name of your LLC, or you're investing into a syndication deal in the name of your LLC. Everything I've outlined in my 3 previous examples can still be done, and it's all routed through whatever you end up naming this LLC, as opposed to your named Advanta retirement account. So the context of setting this up is that you would provide an operating agreement listing that you are the manager of the LLC. The LLC is going to be manager managed, and the member of the LLC is 100% your retirement account. When you provide those documents to Advanta IRA, we will coordinate executing the transaction. It's also very simple to go set up the bank account, and we can help you through that process. But it is something that you can go to any bank of your choice. Once you have the LLC operating agreement set up and you've registered the LLC in the state of your choice, you can go into any financial institution, walk in and just say, hey, I would like to establish a basic business checking account in the name of this LLC. Here's the articles of organization that prove it exists. Here's the operating agreement that proves I am authorized and capable of signing on behalf of this LLC. And that's how you get that done. It's very simple and straightforward. I've worked in financial institutions and also worked on Advanta side for that matter. And I can tell you this is a pretty simple thing that you can get done very easily. Someone did ask, what about a Wyoming LLC? As I just mentioned very briefly in passing, you can set up these LLCs in whatever state of your choice. There are certain states that force you to be a resident to establish an LLC in them, but there are other states, potentially like Wyoming, I think Delaware is one of these states, that you may have a specific additional benefit that you're aware of for registering the LLC in that state specifically. From the administrator standpoint, it's completely up to you to pick where and how you register the LLC. As long as we receive the documents to fund the LLC investment transaction, it's not our duty to point you in the direction of where you must register it. A lot of people do just use the state of their residence, but some people, as this participant mentioned, Wyoming may be a good state for you. Delaware may be a good state. Other states may have their own interpretation of LLC setup rules or purposes that it may be good to look for them. That's part of your personal due diligence in the self-directed investment strategy. So again, with the True Checkbook Control LLC, it is a single member LLC, and the IRA account must own 100% of the LLC's membership. There are ways to do multi-member LLCs and partner more than one entity together. I say entity because this could be an LLC set up with you as an individual and your retirement account. Just like I talked about partnering with real estate deals, you could partner into an LLC, but it then becomes a multi-member LLC that is seen slightly differently from the IRS's standpoint. If you are looking at this and not sure about the rules and regulations, there is some tax law and case study that supports that you are allowed to be the manager of your retirement accounts LLC. I've got two specific items listed here: Swanson versus Commissioner, dated 1996, and the tax court memo of T.L. Ellis, dated 2013. Those basically, to sum up simply, indicate that yes, you can be the manager of your retirement accounts LLC. They also indicate you're not supposed to compensate yourself for any duties that you complete as the manager of your retirement accounts LLC. So you're doing all this at no charge, at the discretion of yourself, just knowing that you're creating a benefit for your future self. That's the IRS's standpoint, is this is a retirement account set up for your future self. You should not be getting a current benefit or a current earning from these dollars because of your responsibility that you're choosing to take in setting up an LLC and being the manager of that checkbook control IRA. That pretty much concludes today's webinar. I want to thank everyone for participating, or if you're watching the recording, thank you for taking some time and learning with us today. Please feel free to contact me if you have any other questions. I'll keep this open for a few more moments as I go into just some general information about how to get set up and started, and also providing my contact information again on screen. Very much implore you to check out our other events going on. We try to put out 2 new educational webinars like this a week, on Tuesdays and Thursdays primarily. We also have a podcast, the Alternative Investing Advantage podcast, hosted by my colleague Alex Perney, that gets a little bit more of a deep dive into specific strategies and with guest speakers that are industry experts in their own lanes of the investing world. So check that out if it's of interest to you. We also have a blog on our website. If you're interested in some general retirement investing news, anytime legislation comes up, we blog about that and put out change.org petitions in the case of a few years ago with the some of the laws and regulations that were affecting our industry. I do see a few questions coming in, so I'm going to go ahead and just get through one more thing real quick, and then I'll address some of these. Again, please add your questions before we wrap up so I can get those answered before we finish. As I mentioned earlier, it's very simple to get one of these accounts started. It only takes about 15 minutes to complete our application. The application is really only 6 pages, 7 if you're using multiple funding sources. It's very straightforward and simple. We collect them mostly via DocuSign, so you really don't even need to print anything in most scenarios. You can get them funded very easily, as I went over to in depth earlier, and you can start investing roughly within about a week and a half to 2 weeks with your brand new self-directed account. Here's my contact information. I'm going to leave this on the screen for the rest of this webinar while I answer these last few questions that have come in. I implore you to reach out either to myself directly with my phone number or email there, or our social media pages. If I can answer anything, help you in any capacity, please reach out. I'm always happy to help and assist, even if it doesn't lead to you opening an account. I feel like my best interest is being a steward of financial literacy. So anything I can do to pass along my expertise and information makes me feel satisfied and helpful in the long game. And it really ultimately may end up in you referring someone else over to us that may have a better interest. If it's not a good fit for you, but you get a good experience, maybe someone else is a better fit for, and you speak with them and point them in our direction as well. So someone mentioned, I did not see the estimated Advanta custodian fees in the case studies. That is correct. Because this webinar is going onto the internet and going to be there in perpetuity, we do not have our fee agreement here for display, because someone may be watching this 5-10 years down the road. Having said that, we very rarely have ever updated or changed our fee agreement. Again, I've been with the company for about 7 years, and it's very slightly changed over that whole time. So If you're interested in looking at what our fees are, very happy to send that to you. Just email me one-to-one and I will email you back a PDF of our fee agreement to review, and also be happy to answer any questions you have as you look it over. The next question here: if I'm a current resident of Virginia planning to move to Georgia in 2 years, what should I do to stay relevant to IRA rules? For that individual, there's really no change state by state in the IRA rules because they're set forth pretty much by the IRS. So it's not a state jurisdiction or a state by state change in any capacity. So I think moving from Virginia to Georgia is perfectly fine. If you are an existing account holder, just update your contact information when you do make that move, so we have accurate records for you. But nothing with your investment strategy or goals should really change given the move from one state to another. If you have more specific questions I may be not hitting on right now, please, again, if you're an account holder of ours, reach out to your account manager. If not, reach out to me and I can answer those for you and help you further. Next one: can I deposit both traditional IRA and Roth IRA in the same year? So that goes back to the contribution limit rules that I outlined earlier in the webinar. You are eligible for up to $6,500 or $7,500 if you are over age 50, and that is a cumulative total for all of your traditional or Roth IRAs. So to answer that question, yes, you can deposit into both traditional and Roth IRAs in the same year. Your total is a concurrent $6,500 or $7,500. So if you put $6,000 in a traditional IRA and you want to put $6,500 in the Roth IRA and you have earned income to support that, feel free to go for it, but you cannot put $6,500 into both. The total is the total for you, period, against any of the multiple traditional IRAs you may have or multiple Roth IRAs you may have. The only other caveat there is, and I alluded to this briefly earlier, if you're looking at a Roth IRA contribution, there are some phase outs for deductibility, depending on what your income level is. We can answer that question for you more thoroughly once we start helping you with the onboarding process. Or if you're an existing client, again, reach your account manager. They can outline those specific rules and the contribution limits and how they relate to your specific scenario. That pretty much wraps up all the questions I see here. The individual that asked me about the fee agreement said thank you. So I look forward to hearing from you soon. And I hope everyone has a great rest of your day, night, weekend, whenever you're watching this. Hope this has been very helpful. Please feel free to reach out as you see fit if we can assist you any further. And that has been it for today.